Hey everyone, welcome back to Corporate Decoder, the place where we decode what really goes on behind those official corporate filings. And let me tell you, this latest report from Greenidge Generation Holdings Incorporated has some interesting twists and turns hiding in plain sight. Get ready for a wild ride through fluctuating revenues, big debt numbers, and a whole lot of legal wrangling. We are going to break down their latest quarterly report for the period ending the 30th of September 2025. Before we dive in, if you like getting the real story behind these financial documents, make sure you are subscribed and also join our Discord community. The link is in the description below. Alright, let's start by looking at what Greenidge actually owns and owes. As of the 30th of September 2025, they had about $7.6 million in cash. That might sound like a lot, but then you see their digital assets, which is mostly Bitcoin, worth nearly as much at $6.1 million. Now that might seem stable, but compare it to the 31st of December 2024, where they had over 6.9 million in digital assets. So a dip there. Looking at their total current assets, which are things they can turn into cash pretty quickly, they had about $21.8 million in September 2025, down from $26.8 million at the end of 2024. This drop is mainly because their accounts receivable went down significantly. On the flip side, let's look at what they owe. Their current liabilities, the bills due soon, were about $24.5 million in September 2025, up from just under $19.4 million at the end of 2024. A big chunk of this increase comes from something called accrued emissions expense, and also long-term debt that is now due within a year. Now for the big one, their long-term debt. This is the money they owe that isn't due right away. In September 2025, this was a whopping $42.3 million, which is actually down from $68 million at the end of 2024. That sounds good, but we'll see later if this drop is truly a positive sign. And then there is the accumulated deficit, which is basically all the losses they've ever had minus any profits. This number is quite large, at negative $387.5 million. This shows that the company has a long history of losing money. Okay, now let's talk about how much money they made and spent. For the 3 months ending the 30th of September 2025, their total revenue was about $15.2 million, up from $12.4 million in the same period the year before. That is a decent jump. Their data center hosting revenue, which is from renting out space for Bitcoin mining machines, was about $6.3 million. It's slightly down from $6.5 million last year. Cryptocurrency mining revenue, where they mined Bitcoin themselves, jumped up by 28% to $4.2 million. This is partly because the price of Bitcoin itself shot up by a huge 87% in this period. But the flip side is that mining Bitcoin got a lot harder, with difficulty increasing by 51%. And then there is power and capacity revenue, where they seem to be selling excess electricity. This area saw a massive increase, up by 83% to $4.7 million. This suggests they are either selling more power or getting much better prices. Now let's see what it cost them to make that money. Their total operating costs and expenses went down by 12% to about $14.9 million. This is good news, as their expenses dropped more than their revenue increased. And the result for the 3 months ending the 30th of September 2025, they actually reported an operating income of $304,000. This is a huge turnaround from the operating loss of nearly $4.7 million in the same period last year. But here is where things get really interesting. A massive $11.5 million gain on troubled debt restructuring flooded into their other income. What does that mean? It seems they restructured their debt and got a big one, time benefit from it. This is largely why they moved from a net loss to a net income. For the 3 months ending the 30th of September 2025, Greenidge reported a net income of almost $12 million. That sounds fantastic, but compare that to a net loss of over $6.3 million in the same period in 2024. The gains from the debt restructuring are clearly the driving force behind this massive swing. Looking at the 9 months ending the 30th of September 2025, their total revenue was $47.3 million, a modest 6% increase from $44.7 million in the prior year. Again, data center hosting and crypto mining revenue were down, but power and capacity sales more than doubled. Their cost of revenue, the direct costs of providing their services, went up by 22% to $37.9 million. This is a much faster increase than their revenue, which is not ideal. However, their selling, general, and administrative expenses, the overhead costs dropped significantly by 32% to $9 million. This shows they've managed to cut down on corporate costs. As a result, their operating loss for the 9-month period was $5.5 million, which is still a loss, but much better than the $10.1 million loss from the previous year. Interestingly, when you look at adjusted EBITDA, which tries to strip out one-time events and give a better picture of ongoing operations, it was $3.1 million for these 9 months, an increase from $2.4 million the previous year. This suggests that the core business, excluding the mega debt restructuring gain, is showing some signs of operational improvement. Let's dig into some of the key metrics for the third quarter. The MWS for data center hosting decreased by 17%, meaning they are using less electricity for that part of the business. On the other hand, MWS for power and capacity sales increased by 10%. This aligns with the revenue shift we saw earlier, and the revenue per megawatt H is up across the board. For data center hosting, it jumped 18%, for crypto mining 64%, and for power and capacity a huge 66%. This means they are getting paid much more for each unit of energy they sell or use. Now, about the actual Bitcoin mining, total Bitcoins produced were down 43% from 166 to 95. Again, this is due to that increased difficulty and the Bitcoin halving event in April 2024, which cuts mining rewards in half. But as we saw, the average Bitcoin price was up a massive 87%. Making up for fewer coins mined. They mined 95 Bitcoins and the average price was over $114,000. Looking at their mining fleet, they have over 7,200 of their own miners, with the Bitmain S19XP model being their most numerous. The average age of their miners is about 2.1 years, and their average efficiency is 21.3 joules per terahash, which is decent. Here is a critical slide: the cost to mine 1 Bitcoin. For the third quarter of 2025, it cost them about $70,000 to mine 1 Bitcoin. Now, the value of each Bitcoin mined was about $116,000. So they are making a profit, but the cost to mine 1 Bitcoin has gone up significantly compared to last year when it was around $49,000. This means their profit margin per Bitcoin is shrinking even with higher Bitcoin prices. Now, let's talk about the risks, because this company has quite a few. The biggest one they are stating there is substantial doubt about our ability to continue as a going concern for a reasonable period of time. That is a serious statement. Their projected operating cash flows are not enough to meet their existing debt obligations, especially those senior notes due in October 2026. And it gets worse. Their stock has been in hot water with Nasdaq, facing delisting multiple times due to low stock price and market value. While they've managed to regain compliance for now, there is no guarantee this will last. If their stock gets delisted, it could really hurt their ability to raise money and could make their shares much harder to sell. This reiterates the debt problem. They have almost $38.4 million in senior notes due in October 2026. They are trying to deal with this by buying back debt, issuing new debt, and selling assets, but they themselves admit their cash flow projections show they won't have enough to cover these payments. This is a massive red flag. Then there are the environmental issues. They have significant liabilities related to coal ash with over $17 million set aside, plus another $13 million for landfill liabilities. On top of that, there are ongoing legal battles over their Title V air permit for the New York facility. They have a settlement now, but it is still uncertain if it will hold up. And to top it all off, they might have to issue a lot more shares to raise money. They've already sold a good chunk of shares through various agreements, and they have plans to potentially sell even more. This will dilute the ownership of existing shareholders and could push the stock price down even further. So, my take on Greenidge: they are in a tough spot. They have a business that is clearly sensitive to the volatile crypto market and energy prices. While they've managed to cut costs and generate positive adjusted EBITDA, the massive debt load and the looming maturity date in 2026 are serious concerns. The fact that they admit they might not have enough cash to repay their debts is a huge risk for any investor. The hope lies in their ability to sell more power at better prices and maybe sell some of their remaining assets, but it is a high-stakes gamble. The environmental and legal challenges also add a layer of uncertainty. Alright, that is our breakdown of Greenidge's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. And don't forget to check out the Discord in the description for more in-depth discussions and connect with other corporate finance enthusiasts. Thanks for watching. See you next time.